Hi, listeners. Welcome to It's the People, an interview series where we explore the inside story of building companies and investment portfolios with high octane founders, limited partners, and fund managers. We hope these conversations push you to be even better at what you do. My name is Andy Greenfield. I'm a general partner in TIA Ventures, and this week my partner Wills Hapworth and I had the opportunity to interview Joel Mesznik, who is an active investor and has been throughout his career, as well as being a key advisor to many very successful high-growth technology companies. Joel has helped build, buy, and sell multiple companies in partnership with private equity funds, venture funds, and institutional debt providers. He currently manages his family office and has over 30 years of experience investing in venture capital, private equity, and credit and distress funds. He's a global citizen who grew up in Europe, speaks 5 languages, is passionate about investing, very competitive, loves what he does, and Joel is truly one of the nicest humans I have ever met. In today's interview, we discuss a range of topics, including how to apply life values to succeed in business, the power that comes from always staying cool and collected regardless of the situation, Joel's strategy around backing strong funds that create co-investment opportunities, and much more. To start things off, Joel begins the conversation by distilling his life into 60 seconds. But before we begin, I want to note that this interview is for informational purposes only. The opinions expressed here should not be relied upon as a basis for investment decisions. TIA Ventures is a seed stage fund focused primarily on early stage B2B technology companies with an obsessive focus on end customers and early teams. Joel, to get rolling, you've had a long and many splendored life. We'd love to see if you can boil it down to a minute or two, if you can just give a quick picture of Joel the man.
Okay. Fair. I grew up in Vienna in Austria, earned my A-levels in England, got my engineering degree and then a business degree. My business degree was international finance. I then worked in engineering for a short period of time on nuclear power stations, and then I moved to finance. And I've been in finance on Wall Street initially, doing what is known as public finance, which is financing for nonprofits, universities, hospitals, turnpikes, airports, anything that has to do with public purpose. And as an aside, on a pro bono basis, I'm doing the same thing for the Metropolitan Opera in New York right now. So I enjoy doing that. And for the last 20 or so years, I've also done my own investing after leaving Wall Street. And my own investing has been in venture capital. I also ran a healthcare fund for 25 years in Europe. And I've been a selective episodic investor in real estate. And those are the things I've done.
So my recollection is you started at Drexel. Is that right?
Well, after my MBA, I started at Citibank, and then I moved to Drexel. And at Drexel, I was hired to create a municipal bond department. My expertise was on the investment banking side, structuring transactions, getting them rated and selling them publicly, not on the trading side. And then after 15 years of that, I moved to doing some merchant banking in Europe before leaving Drexel. And then I started doing my own thing.
Can you talk about your move from working in these big institutions to being a guy who's, investing, guiding entrepreneurs? You've done a whole bunch of different things, but your move from these multinationals to Joel and company, can you talk about that move?
So I think I moved from a structured environment to a non-structured environment when I moved from Citibank, where I started my finance career, to Drexel, because Drexel was a totally unstructured environment. Although it was big, you ran your own kingdom, and I was lucky enough to run my own kingdom. And so I don't have much experience in very structured environments. My experience is much more, just trying to do things within certain guardrails, but certainly doing things that I find interesting and lucrative.
So you combine some interest, because you and I go way back, some interesting things that normally you don't think of going together in one person. You're often dealing with very, very large sums of money, which tend to create people with sharp elbows, raised voices, things like that. But I would say you're one of, if not the most unflappable guy I have ever met. And you combine huge humility with huge success. Can you talk a little? And those are two pairs of things. Big money, sharp elbows, and unflappability, and then we'll get to humility and success.
First of all, thank you for the kind words. I have avoided dealing with people and transactions which take sharp elbows. It's just not worth it for me. So I've stayed away from it. I've been friends with and have either advised, consulted, or been on the other side of transactions with billionaires with very high opinion of themselves. But that hasn't changed my approach to life. Life is about values. So I don't mean to get into anything other than business, but life's too short. And I've tried to teach my kids the same thing. And one of my kids just bought a business, and the opposing side said to me, it's funny, I ran into the opposing side yesterday, and he said to me, he's never dealt with people who were totally professional, knew what they wanted, but were never disagreeable. Which I consider a great compliment. Thank you.
It's a wonderful compliment. And one of the things I'm really curious about is, have you always been this cool, calm, collected guy? I don't think I've ever heard you raise your voice.
It's funny. My wife, I've been married 42 years. She said she can only remember 2 or 3 times when I've raised my voice. She might consider it to be passive aggressive on my part. Not to, but that's for her to talk about. I don't see reason to. I think you lose control of an environment you're in if you raise your voice.
Yeah, that's interesting mentioning control, because I think of you as a guy who is controlled and maintains a good bit of control over your environment in a positive way.
Well, I'm goal-oriented, and I don't think you gain much by raising your voice and being irrational. And as long as the other side recognizes that, I think it's smoother for both sides.
Did this way of being come from somewhere? Did you see that this was a more effective way to conduct business at an early point in your career that you then just continued to apply?
Wow. I think it's my upbringing and personality. Because I've dealt with people that are screamers and yellers. At Drexel, I reported to head of fixed income, and he would scream across the whole trading floor when he wanted to talk to you. And I would just slowly approach his corner office. And by the time I got there, my hope has always been that he would relax. Oh, usually he did. Sometimes he would just smile at me and say, I can't get excited. But it worked well. Thank you.
I'm just curious if I could pry here. Was there like a moment in your younger life where you just realized, I think of this sort of similar to my father, because this is very similar to his approach. And like, where did this style come from? You mentioned behavior, but you also mentioned upbringing. Was there something around the upbringing? Because I think this is super relevant for the entrepreneurs out there listening, as far as how do you make things happen?
I'm not sure. I'm not sure. I mean, my parents got divorced. My father left when I was very young, and I was, I think, 9 years old, never to be seen again. And I grew up in a very modest, incredibly modest environment. My mother was tough as steel, and she never raised her voice. Although I always knew what she wanted me to do and not do, and maybe that's where I got it from.
That almost sounds like a description of Joel Mesznik. Never raises his voice, but you always know what he wants you to do or not do.
Well, Andy, you and I were on the other side of a transaction at one point. And although we didn't always agree, we got it done and we remained friends. That's important to me.
And we have. Let's shift gears to the other pair of things that don't always go together. And that is great success and great humility. Because, if I think of, and I've known you for 20 something years now, I've never, ever seen you not humble. I've never seen you come within 100 miles of being pompous or bragging. Even when you've just, experienced a huge win, the company selling for hundreds of millions of dollars, where you were the original investor when it was an idea on a napkin. How do those things go together? Because it's very uncommon.
Wow. I didn't think that this interview will go in this direction. It's just my personality. I want to be humble. And again, you were at my son Jared's wedding, and he's the most humble person, and yet he's incredibly successful on Wall Street, managing risk of many, many dozens of billions of dollars, and it has never gotten to his head.
Well, yeah, it's a good father.
You create values not by telling your kids what you want them to know, but by doing what you want them to. Setting an example is not talking about it; it's doing it.
Interesting. We were just having a conversation with an entrepreneur who's now hired a pretty substantial, early executive team, and they're starting to think about how to infuse culture in like a real way, not just here are the 5 words, but like, how do you operationalize this? I have to imagine you've worked with a lot of people around how to build a culture and like to do it, not just say it. Any advice on how you actually operationalize those things, whether it's with your family or with, the people that you work with in business?
Yeah, I'll give you an example. My son, who works in Wall Street, he has about 50 traders reporting to him, about 50 traders reporting to him. When it comes to bonus time, he hands out a huge amount of bonus money. But then he tells them that they should pick 3 charities and contribute to that if they choose to. He doesn't want it to be, this is very political, of course. He doesn't want them to be political. He doesn't want them to be gun lobbies. He has certain restrictions he puts on it. He says, I'm going to match whatever you tell me you put into the charities. So some of them send him receipts to prove that they have given. And he says, I don't want to see those receipts. Because if I trust you with a trading, balance sheet of $1 billion, I don't need to see a receipt for $10,000 that you're giving to Planned Parenthood. That to me is, you trust the people you work with, you set examples, you match them by taking their word for it, and you move forward.
Well, that's...
In terms of corporate cultures, this is corporate culture, of course. In terms of startups, I've seen it from the worst to the best. The best of people that set example by acting with humility, with listening to people that work for them, by promoting a culture of listening, Obviously, harassment and so on is just not acceptable. But listening to them, also by limiting, always being open, but having very defined reporting lines. You don't step on your reporting line. You have an open office. Everybody can come in and talk to you, but you immediately, if it becomes a matter of the business, then you want to tell them, let's go through the reporting lines. Because a CEO cannot listen, on business matters to 25 people.
Yep.
He needs to trust 5 C-level people that he has hired to do that. And many founders just don't get it. It's an open environment.
Joel, I'm one of those. Way back in the old days, I used to pride myself on having an open door, and people would come in and present stuff, and then they'd leave, and their manager would end up walking in saying, "What's going on here?"
Right.
And they'd say, "Well, maybe you don't need me if, your door is open like that."
Yeah. The other thing I learned was it's different right now, but in an era where people had their own offices, I tried to avoid having people come into my office. If they wanted to talk to me, I would say, "Let me come right back to you." And I would walk into their offices, which limited the amount of time I had to spend with them and didn't make it uncomfortable for me to stop a conversation in my office, ask them to get up and leave. So I would always say, I'm doing something right now. Let me get back to you. I'll come to you in a minute. And then I would walk over to them.
That's a great piece of advice.
I want to shift gears for a second. You're a guy who I think speaks 5 languages, has lived all over the world. I think one of the last times we were talking, I was asking how often you've been to Europe, and it was, in the hundreds of trips over the last. So not only are you a global citizen, you've stayed kind of actively international. Does that factor in at all to the way you make your investment decisions, the way you look at companies, just the way you think about business and your activities there?
It does. And oftentimes it has been to my detriment. As an example, for 20 years, I've invested in a Brazilian ETF, but that's the dream that never happened because they always screw it up when they can. So much in resources, both human and natural. So that's one example. But the other example is I serve on an investment committee for a pretty large endowment fund, $400 or $500 million. And we have a consultant who comes in and suggests different things. And one of the things we just discussed was, do you invest in venture capital in China or not? And I voted against it because of the political situation. I think the Chinese government is just not a friendly government long-term to be supported. I was overridden by some other committee members who said, if you invest in venture capital in China, the Chinese government will help startup companies for the first few years. But if the company makes it big, then the political constraints will come in. So I just didn't want to have to worry about timing of when I want to get out or when I'll be able to get out. So for me, it's a binary decision. Just don't do it. I think that there are great opportunities in emerging markets. When I ran my healthcare fund for 25 years, I insisted on having about 15% in the emerging markets. So I'm an internationalist. Maybe not the proper word right now in this political environment, but I think of myself as an internationalist.
I mentioned the 2 pairs of things that didn't seem to go together. There's another really fascinating part of you. You are, when I think of, technology, a technology guy, I don't think of Joel Mesznik. On the one hand. On the other hand, you've been an immensely successful technology investor. Can you help And I know you don't no longer use an abacus, but can you help us understand how those two things fit together?
Joel, I have a distinct memory around this on the phone with you, trying to sort out a PDF that was in your inbox. So this is something I'm very curious about. Like, are there mental models like
My God.
don't involve you having to use technology that enable you to be
Well, see, you're absolutely right. I now remember I couldn't. Yeah, okay. We know I'm not a technologist, not at all. You know, my kids laugh at me. The same comment that you made. You know, like you've invested successfully in technology. So I look at people and their abilities to manage and to be not rigid but be nimble. So Andy, Greenfield Online would be a great example. We bought it, as you remember, in 1999. By the year 2000, we had filed to go public. The public offering, the markets collapsed, and we realized we have a business model that's not sustainable. And we had a CEO who was, I want to be humble. So we replaced our CEO. And we got a good CEO in. And that CEO took us for the next 4 years to an IPO. But the week before the IPO, he called me up and said, unless you double, and the numbers may not be quite, double my option plan before the IPO, I'm going to quit, knowing that we can't have an IPO if the CEO quits. I told him, quit, go ahead. I'm not going to be blackmailed. And we did the IPO, and maybe a year after the IPO, he was gone. In the meantime, the business model changed twice. In 2000, we eliminated what I will call the retail market research business and just went to be a supplier of data to the existing entrenched market research companies. And then in about 2006, we made it a much more software-oriented business with technology as the driving focus to create margin. So in both instances, we had to do it by changing management. In the case of Applause, a company that I think you know about, where a guy comes to me on a napkin, shows me an idea, and I say, it's a great idea. So I did a couple of things. One, his background was very interesting. He came out of an Israeli military unit that's very highly regarded for the technology acumen. They did get selected in high school because of their talents. And he was great. And we had to change the business plan a couple of times. Again, I was a seed investor. We ultimately did 6 financing rounds and sold it to a big VC that took it from there. That CEO was able to move with the market, the demands of the customers. But when it came time to sell or to do an IPO, I said to him, your personality would never let you be a public company IPO CEO, public company CEO, because you're rude and your personality is just harsh. And so he totally gets it. He was a guy that understands himself.
Joel, if I may here, because you use the idea of idea on a napkin, and I know that you have been, at times the first check into ideas on a napkin. And you mentioned the ability to manage, background of the founders, technologies that seem like good ideas. And yet you're a self-identified not technologist. Sometimes backgrounds don't tell the whole story behind an entrepreneur. Like, they could have gone to the top med school and they just didn't get the right, maybe they worked at a top investment bank and they didn't get real deal experience. And ability to manage, oftentimes you don't really know until the companies have moved well beyond the napkin stage. Are there other themes or cues that you look for as a very successful technology investor who's often in at the ground floor? Because you might not know the ability to manage whether or not, if this person's background is in fact legit.
You froze.
Will's froze, but you and I haven't.
Okay, so Will's.
Are there other things that you're looking for, like right at the moment where the idea starts to,
Yeah, so a couple of things. First of all, we're very lucky here to discuss only my successes. I've had many failures, and there were more failures than successes. So not always calling it right, for sure. You look at personality, ability to interact with other people, to I don't know how to explain it, but there's chemistry involved. And I will also mention, the two transactions which I totally blew. One of them was a guy comes to me with an idea, I don't know if you know Tableau, but it was like Tableau. And I thought he was brilliant and he had everything it took. And we couldn't agree on the valuation on a seed round. And I'll just throw numbers around. I thought 4 million was fine, and he thought 5 million is a minimum. And I walked away because I didn't feel that I could work with it. Within 4 or 5 years, he sold the business to Salesforce for about $800 million. So I was very foolish, not understanding him, and also being dogmatic about my thinking. Another one was two guys, brilliant guys that had an understanding of security very early on. And, it was a few $100 million sale within a few years. So those are mistakes I made. I also made mistakes. A company which was in voice recognition, they seemed to be way ahead of the competition. And they got Office Depot as a big $2 million annual run rate. And we piled in and brought in a lot of investors. The company never got another big logo because management was so bad. I totally misjudged management. What did I misjudge? There was a CEO who was afraid of his own shadow, always felt that everybody's throwing around him to the investors. And we didn't talk to his, other employees. And the co-CEO was just a fraud. So, I made mistakes. You're going to make mistakes. But what I want to do is I want to pivot to a thought, which is where to invest at different times in the ecosystem. So I'm originally a seed investor because I thought there were incredible ideas during the time period between 1998 and 2005 or 2010. Great ideas. You could do very well in seed investments. A lot of them were B2C. But then over the last few years, I switched over to growth investing because there was much more certainty of outcome. You had a validated business model. You had an existing management team that had proven itself. And you were certain to get a 2 or 3x in pretty much 80 or 90% of the transactions. But what I found over the last 2-3 years is that there's so much money that went into growth investing that I've shifted back into seed investing, because seed investing, again, the performance of seed investing is highly dependent on the amount of growth capital that's chasing the B rounds and the C rounds. And so if I'm in a seed, and if I'm in with a fund that permits me to do co-investing and basically cherry pick the best ones in the B and C rounds, I'm going to outperform growth investors. And so, it's basically, and Andy and I have had conversations. That's why I'm back investing in seed investments. But when you do that, there are two ways of doing it. One is you invest with a team that really understands a specific vertical, or you invest with a team that just do a very scattered approach and puts a lot of small amounts of money into a lot of transactions. I think of you guys as guys that really do a lot of due diligence, really understand your verticals, and you'll have a great track record based on understanding what you're doing. I'm also invested, for example, with one fund, which basically will put out $250,000 checks, although it's a $100 million fund. They can never track any of the deals. They don't mean to track any of the deals. But when the companies come to the next level, and they don't help management, but they have a wide enough array. So when it comes to the potential of a B round, if I can co-invest with a growth investor, I have again cherry-picked the seed ecosystem. Those are the two approaches that are now, I think, very beneficial. Let me put it that way.
Well, Joel, if I may, this concept of cherry picking is very relevant because everybody wants to cherry pick the best investments in an early stage portfolio. How do you, because obviously, you know, those are the ones that are most likely to succeed, de-risked, and yet you still need to enable some mechanism for finding those great ones. How does that inform your strategy around investing with funds, you know, and investing in the co-invest?
So for the last 2 years, I stopped doing one-offs because what I found is that the risk reward without my great technological ability is minimal. There's just too much money chasing that stuff. But you guys know what you're doing in a vertical that you have really done a great job in. And so if I invest with you, I ultimately hope to have the ability to cherry pick from your portfolio. And I've done it, as you know. Is it unfair? I don't think it's unfair. It's a strategy that I'm using.
I would argue, because we hear a lot, you know, hey, I'd love to co-invest in your certain deals, but the kind of implied messages, but I don't want to be in the fund. And I always come back to, well, how do you expect us to do the work we're good at?
I don't expect you to do that. I don't expect you to permit me to just cherry pick unless I'm in your fund.
Right.
And my hope is that your fund will do well enough, but that I can gain incremental returns by being invested in later rounds.
Yep.
Where I'm not the one cherry picking. It's going to be the growth investors that are cherry picking your fund.
Mm-hmm.
So I don't have the liberty of doing that. But what I do have is a mechanism by which the growth investors, and some of them are foolish right now. If you look at the amount of money that they have chasing deals, I know if an investor, Andy knows them well, just raised $19 billion and just wrote a $20 million check. How do you do that? The only reason they're doing it is because that's the only way they can get into the B and C rounds.
Yep.
So that's the mechanism where I'm trying to fit in as a personal investor.
Yep.
By the way, congrats on a company that you invested in with Bob Green.
Yes.
Okay.
I don't want to go into details, but I pushed hard when you got the big term sheet.
Well, Joel, you're a guy who I'm guessing gets pitched pretty regularly by funds. And I'm guessing you don't pull the trigger on the vast majority of them. What rings your bell when you go, okay, this is worth paying attention to, this is worth writing a check on?
People, it's all people skills. Track record is important, but it's the people that I'm with. I don't feel comfortable with them.
I'm smiling because the title of our podcast series is called "It's the People," which we heard from another one of our LP.
But it's the people on one-off, which fund do I pick or which company do I pick? But I'm a strong believer that you need to look at the whole system of where money is flowing. And I'll give you two examples, if I may, quickly. One is I've looked at and I've invested in real estate funds, debt funds. And so they pitch you, and they've pitched me, and I've invested where they can get on senior debt, construction loans, but senior, to go up to a loan to value of maybe 60%. And they'll do some preferred equity, but it's going to be a minor portion. And they'll get you a 12 to 14% ultimate cash on cash. But over the last 2 years, they've shifted a lot of the investing, and the portfolio now looks mostly preferred equity, which is lowered down the security of your loan and the moving down in order to give you the return they promised you. So the clear signal is that even if the management is good, the people are good, the ecosystem that they work in doesn't permit them to meet their goals because of external factors. So much money has come in to the whole system that they have to move down. And the same with middle market lending. I'm an investor, it's for cash flow. But whereas you used to lend to companies with a $25 million EBITDA, now you're doing it to companies with 5 or 10 million EBITDA, which is much higher risk, of course. But that's the only way you can get the returns you promised. With seed investments, you can't quantify up front what you're going to get because you're not investing into a structure, into a balance sheet.
Are there any?
And just so we understand, you get comfortable with that risk largely based on the people.
Yeah, but no. So I didn't make my point properly. I initially invest based on my comfort with the people and the fact that they're going to be lending senior debt. But for them to achieve the returns that they promised you, they have to go down the stack of the balance sheet to preferred equity, which is much less secure, of course. And it's loan to value 60 to 80% in order to achieve the goal. So although I like the people, I understand why they're doing it, but they've been forced to do it. So as good as the people are, they have to change.
Yep.
In seed investing, you don't have that issue.
Mm-hmm.
Although you do, because there's so much money chasing seed investments too. But you can do a lot better there by being picky, because it's a much less efficient marketplace.
We sometimes hear that because of some of the trends you're talking about, multi-billion-dollar funds deciding they're getting into seed, that this is a bad time to get into, to invest in VC. Things are overvalued. There's just money flowing in. People say, step back. It's not a good time. What's your point of view on that?
I'm not sure I understand your question.
So we've heard, as we talk to, we're in the middle of a fundraise now, as we talk to prospective VCs, a lot of them raise the question, is this a good time to invest in venture? Or is everything just overvalued because of this huge pipe of, giant funds pouring cash down into seed and Series A, et cetera?
So I don't think they're right, because ultimately, if you put your money in at the $4 million valuation, because there's a lot of, because you have kind of exclusivity on the idea initially, or you put it in at 7 million because you have much more competition on the deal, your ultimate return math, if you're good, will not change that much, because the follow-on rounds will dilute you, of course, but will be at much higher valuations. So your overall math will be okay.
let me throw in, Wills, did you have a question?
I'll go for it.
Okay. Yeah, one more pair of things that when I think of Joel Mesznik, I kind of go, whoa, those are things you don't necessarily see together in one person. I don't think of you as a type A. I think of you as a very, thoughtful, measured guy. Yet, when you and I first met, you went from our first meeting to having me come in to pitch to doing a deal in, 72 hours, 86 hours. It was something very, very, very fast. How do those go together? That speed of movement along with a guy who's, not over caffeinated,
Well, I think it's simple. It doesn't take you 600 hours of thinking. If you like something, 20 hours of thinking. You build in your mind the model of who the people are, what the idea is, what the market is, and you do it quickly. You don't have to ruminate for days and weeks on end. Yeah, tell me, in your business, if you don't make quick decisions, you'll never succeed. You make a quick decision, then you make due diligence happen.
Yeah.
But you don't put the due diligence ahead of a binary, I want it or I don't want it.
There's another interesting thing I think about. I think of you as a guy who's been there right at the start, when a company's being born, and able to provide ongoing advice as, the baby comes out of the womb, as it goes through, infancy, childhood, adolescence, maturity. But to my knowledge, you're not an operator in the sense that I've been an entrepreneur my whole life, but you've been there almost as a midwife right from birth. Can you talk a little bit about your ability to do that, and not just do it, but do it really effectively, having, from birth, raising these very successful children?
My contribution is minimal compared to what the operators do. My advice is more generic in terms of a company growing and creating systems in place to manage, whether it's pricing, whether it's margin, whether it's accounting. And I've been involved with companies from stage one to going public and being on the audit committee. So I've done that. But my contribution is not telling you which technology will work. It's much more generic to applicable to any business. Let me put it that way. I've worked with biotech companies from the start. I don't understand the science. I have no clue what they're talking about. But, you know what businesses need to do to grow.
Not everybody does, because I sometimes think that as far as, obviously we're managers in a fund and we have a portfolio of companies. We work very closely with our founders. But I think to the rest of the world, sometimes it may look like a black box as far as what we're doing daily with them or weekly or monthly with them. And I know for us, it's, we'll hear something and it'll trigger some pattern that we've identified numerous times. And that's when we know to kind of poke at that thing or pry at it. Is that the way you operate? Or do you come in and say, I already have a kind of model, to your point, of how businesses should work, and start laying the groundwork day one versus responding to the things that you start to hear from, the founders, the entrepreneurs, or the leaders? As they're
it could go either way. It depends if the founders who are technologists or have a brilliant business idea, some of them will just say to me, why don't you help us with the business side while we do what we're best at? In those instances, I have certain ideas how to develop guardrails around a business, and accountability within a business. Other times it's somebody sophisticated and maybe it's a second or third venture. And then I'm just sitting back and I'll probe where I think it's worth probing. But I don't need to be involved if I'm not wanted. And, like some people just want to do their own thing. That's fine too.
Have you had
Yeah, maybe.
instances? Have you had instances where you feel very strongly about things that, these are companies where you've invested and you feel strongly about things that they should do and they choose to go another direction?
Yeah, definitely. As an example, the voice recognition company, we were ahead of the market. Technology was okay. And we just wanted them to go a different way. We didn't think they could just keep on winning, Office Depot $2 million a year contracts, go out and get the $100,000 contract and get 20 of them, because it's going to give you much better footing in the marketplace and brand and recognition and so on. And they just wasted 2-3 years, ran out of money because they just wouldn't listen. And you can't force them to listen. Yeah. I've another instance where great idea, and the founder he's just an idiot. He needs to create a community of people that would contribute certain gut financial information. And he just refused to spend money on creating that community. And so he never developed. It's a company that the marketplace is very fickle, the public trading marketplace, but people have instincts about upcoming earnings. So the company, basically, the goal was to create a community which would input their ideas of non-professionals, what the earnings of Apple will be based on their interaction in the marketplace, them buying Apple products and so on and so forth. And statistically, they were able to predict a week and 2 weeks before an earnings call pretty well.
Wow.
And we took out people that were outside of one standard deviation of the total estimate. And we were pretty good and started selling the product to hedge funds who'd love to trade pre-earning. Nothing illegal. It's all market sentiment. But the guy wouldn't listen in terms of stressing the need to build the community so it becomes bigger, so it becomes statistically more meaningful, and you can cover more stocks. And he just wouldn't listen. And we didn't have the power. The board documents didn't give us the power to replace it.
Two questions, if I may, on this, because this, have there been instances where they didn't listen, and thank goodness they didn't listen, because they did something that you never would have guessed, and it worked out, beyond your wildest dreams? And where you didn't fortunately disturb the magic?
There are probably instances. There might have been instances where we strongly recommended they do something and it tanked the company. I'm sure.
Yeah.
There's no magic here. This is not magic. This is trial and error.
And then the second question, I love this concept. You can't get people to listen. This is something we know well. Is your style generally to keep trying to figure out a way that you finally, speak in the right language? Or is it, hey, I try once, cut my losses, move on?
I try a couple of times and then I'm just giving up. Mm-hmm. It's you know what? It's the same. This sounds terrible. With my kids, I don't tell them 20 times what I think is right from wrong. I tell them once or twice. If they don't listen, they don't listen. The 16th time you tell them something is not going to make a difference.
But your kids, you can never give up on. Do you give up on?
I don't give up on them. I don't give up on them, but I don't keep telling them that.
Yep.
My hope is they'll come back to me and say, what do you think?
Mm-hmm. Yeah, I love that you said,
badgering somebody is counterproductive.
I love that you said that they come back to you and say, what do you think? Not you were right. Because I think a lot of people would like to hear you were right, but your point.
No, I don't care. It's not about me being right or wrong.
Yeah.
It's not.
I'm smiling at both of your examples. The first one, we often preach, because we deal with a lot of folks who want to go elephant hunting. And
Right.
we tell them, you know what? You can grow old and die hunting elephants or starve to death. There's a lot of zebras out there that can feed you. And the second one, which I love that concept of essentially crowdsourced analysts. But
Not analysts, but non-professionals.
Right, no, I know, but sort of crowdsourcing
Yeah,
the foundation for what
exactly.
analysts do, but the guy doesn't want to actually create the crowd to provide the source.
Because he's an idiot. It shouldn't be. I don't care.
So we have a thing at the end, Joel, we call the 2-minute drill, where we ask some questions that might or might not be provocative or interesting. So let's give it a shot. So you're a guy who's been around. You've had a number of birthdays. You've learned a lot along the way, I'm guessing. Best piece of advice Joel Mesznik today gives to Joel of years ago?
Take more risk.
I'm smiling when you say that, because one question we would always ask in interviewing people in their 40s or 50s, if you could rebuild yourself, what would you do? And that's often you hear that. When you finally go to the great hereafter, what would you want your epitaph to say or be?
He was a Renaissance man,
Well, I will vouch for the truth of that one.
I'm sure, Joel, like your life has gone in all sorts of, interesting directions that you never could have expected. If you could go back, rewind the tape, and make one decision differently, does anything come to mind? Something you wish you had done that you didn't, or?
Yeah, definitely. So in 1992, so I left Drexel at the end of 1989. Firm collapsed in 1990. In 1992, I had some connections with capital in Europe, and I started buying real estate from the US government because of the S&L prices blew up. All these S&Ls, the government had billions and billions of loans. And I very quickly bought about 130 real estate assets. And the returns were incredible. I mean, it was like triple-digit returns. And what I didn't do is create an organization around it, because those returns would have committed me. And other people who came out of Drexel, whether you look, I'm not comparing myself, but I can mention 20 or 30 people, all the way from Apollo, Leon Black, and Mark Rowan, and Josh Harris, to Mark Ute with Clarion. I mean, the 20 or 30, to Canyon, which is managed in 20 billion, 25 billion. I can run down a list of guys I knew well that all went out and raised funds.
Mm-hmm.
And I didn't.
Did the thought cross your mind at the time to do it, and you chose not to?
No, I resisted building an organization. I wasn't interested in building an organization. And what I did do, we did a whole bunch of real estate deals that worked out very well. I then, within 2 years, started a fund in Europe in healthcare. And this is, again, I don't know anything about biotech or the science of healthcare, but I picked managers, and I picked what I thought were the best biotech managers and big pharma managers and diagnostics, medtech, and emerging markets managers. And I raised a fund in Europe, and I doled out the money between the managers. And my only role was top down. If I want to be more in emerging markets or big pharma, I went up and down the balance sheet from small caps to big caps and assigned between the managers. And I rotated money between them based on my concept, and did it for 25 years. was voted #1 healthcare fund in Europe after 20 years, and has sold out after 25 years. It's totally unrelated to technology.
And Wills, you can't see, but you froze in an interesting, wow, kind of look. Hey, Joel, over the years, you've made many decisions. What was the hardest decision you ever made? What comes to mind is, wow, this was a tough one.
Investment decisions?
Well, we'll take whichever ones come to mind.
Wow. I haven't been overwhelmed, but I wasn't overwhelmed by any one of the decisions I made.
So you
lost some, but there was never one that overwhelmed me.
And I think of you as a guy who is not a conventional wisdom guy, or a guy who often questions it. What's a piece of conventional wisdom out there now that you kind of look at and you shake your head and you say, not right?
So I'm a contrarian in many investment decisions. And I think the public equity markets are overpriced. Of course, it comes down to stock selection, and averages don't mean that much at that point. But I think a lot of the stock market itself, where you're trading it at double the multiples in the S&P 500, just because interest rates are low. I just think I serve on 2 pension fund investment committees, and, we're trying very hard to protect against increases in interest rates, which will affect our fixed income securities portfolios very hard. The legislation doesn't permit us to get away from bonds. So those are the kinds of decisions I'm going through right now.
Joel, I know I froze for a sec, but I was so curious. Back in 1992, you had a resistance to building an organization around what clearly became a really good investment. And then you did build an organization. I think this is super relevant to managers out there that may have angel portfolios that are thinking about launching a fund. Why were you resistant at the time to building an organization?
At Drexel, I had about 100 investment bankers reporting to me, in my group, and about 100 support personnel. And it took me away from doing deals day to day. I loved doing transactions, and I was totally managing very egocentric, legends in their own minds. Investment bankers all thought that worth a lot more than they were, and didn't appreciate the good stuff that they were doing or they could do. So I just didn't want to do it. I just wanted to do some deals and have fun, and I had the good luck of doing it.
And when you then did go and build the healthcare fund, did you discover that it wasn't quite what you thought it was going to be, in the sense that it was going to, it sounds like you had a perception that by building an organization, it would take you away from doing the deals and the fund, but then you didn't.
Well, I should be clear. My organization was myself and an assistant, because I farmed everything out to the managers, and the back office functions I also farmed out.
Got it.
So I had the luxury of having people in Europe sell the fund. And there was one guy that I had to talk to, and he had his pawns out there doing whatever needed to be done. All I did was macro decisions once in a while in terms of reallocating between managers and selecting managers. And I did it myself. Didn't create an organization. It worked. It was fun.
Yep.
And
Never
Joe,
had stress, never worried, didn't even know what stocks were being bought or sold because I thought I had the best managers. And I always insisted in the ability to fire managers on very short notice.
and Joel, far be it for me to disagree with you in public here, but you said that way back when that was maybe the one decision you would have done differently, building an organization. And I would argue that way back when you actually, made a decision that was pretty much in sync with who you are, because you've done that. You've been that guy who gets his hands dirty for many, many years to this day. Yeah, I think Mesco is you and
Melissa.
and but you've managed to achieve huge success doing the stuff you love, getting involved, not sitting, doing, performance reviews and a bunch of paper shuffling. So I would respectfully disagree or suggest that that was the right decision back then.
I don't know.
And
I don't know. It just, you know what? You know of my involvement with a company that does surveys of doctors and physicians and so on. And we're in the market to sell it right now. And when you look at it, 30 or 40 funds that are very interested in it, there are a bunch of them that are guys that were 24 years old at Drexel, or a guy that I met when he was 22 and had just graduated Wharton. He now runs a big private equity fund, and they look at me as the old man, right? Because I'm 10 years older than they are, 15 years older. But I should be happy for them. They've achieved incredible successes. Measured differently. I don't want to measure success in terms of money and it's not a good way to measure your life.
Joel, I'm curious, you've opened the door to one last question here. How do you measure success?
So I look at human values. I want to be a good person. So that's most important to me. I just, and I know people say that and then they act in devious ways. I don't do that. I'm in your face. If we disagree, I'll tell you. Andy knows that. I mean, it's just, the great example is my son saying to his traders who make millions of dollars, I want you to think of charities, and come back to me and I'll match it. That gave me such pleasure when I heard that. It's just great.
So one final question. As a guy who has dealt with entrepreneurs, excuse me, most of your life, as a man who has helped guide entrepreneurs from ideas on a napkin to huge success over and over again, what one piece of advice, if we had a room full of them who are just starting out, would you offer for them?
Pursue your passion. Be true to your values. Many. But I will turn the question onto you. And have you asked Hugh Davis that question?
That said, for our audience, Hugh is a guy who Joel and I have known since he was a teenager, who has built multiple companies, and he's now an elderly 50-year-old. I think Hugh is a guy who lives according to a set of values, treats people with respect and decency.
Right.
Listens hard, is humble.
Yeah.
I think those are
kind. He's kind.
Yeah, a good person.
I I called him a while back and I told him a common friend of ours is really down and he has his birthday coming up and he's having some issues. And Hugh flew down from Nantucket and took him to lunch. And you know who I'm talking about.
I do. I do.
That was just such a wonderful act of decency, of human caring.
Yeah, and that's why Hugh could. Remember the culture of his companies were so strong.
Right.
People would, fight to get jobs there. They wouldn't leave. Well, Joel, listen, you've been more than generous. We're 5 minutes past our allotted
No worries.
hours.
This was a pleasure.
We're going to pay you time and a half for overtime, and that's going to make a difference. Thank you again, Kip.
Thank you, guys. You guys are great. I love being an investor with you. I enjoy talking to you, and I hope you have great success in what you do.
Thank you, Joel. Really appreciate this time and a lot of great lessons to live by in what you shared. So thank you.
Thank you for listening to our interview with Joel Mesznik, a global citizen who has achieved success at virtually every part of the investment spectrum. During our interview, Joel discussed how to apply life values to business, the power that comes from always staying cool and collected regardless of what you're facing, Joel's strategy around backing strong funds that create co-investment opportunities, and more. Look forward to having you join us for our next interview. And until then, saying thank you from Andy Greenfield, Wills Hapworth, and TIA Ventures.